Hello and welcome. Today, we're going to talk about trade finance providers and lenders and how they can help you and your business grow and expand internationally. What are the types of trade finance lenders? Trade finance providers can be broadly divided into banks and non-bank lenders, funds, and alternative financial institutions. When accessing trade finance, it is crucial that business owners choose a suitable lender from the different types of trade finance service providers that exist in the market. Banks. Banks represent the majority of financial institutions globally, although they range in size from small regional operators to large multinationals. Banks are a popular source of trade finance because their cost of borrowing is often lower than that of most alternative lenders. However, a bank is usually under high regulatory pressure, so there are longer decision times and less flexibility. The specific trade finance services that banks offer vary, but generally include services such as issuing bills of exchange or letters of credit and accepting drafts and trade notes. Two main types of banks provide trade finance: large corporate and investment banks, CIBs, and smaller commercial banks. The main difference between CIBs and smaller commercial banks is the size of their clients, with CIBs generally serving larger clients and larger transactions, while commercial banks tend to serve a wider range of smaller clients. Corporate and investment banks, CIBs. These banks typically handle larger clients and transactions, and their strong global reputation means they can provide cross-border services at a lower cost than smaller banks. Some larger commercial banks also have specialist trade finance divisions that offer trade services and debt facilities. Commercial banks. Smaller domestic banks can be advantageous to SMEs because their financial products may be more flexible and tailored to specific niches and vertical categories. However, as with any bank, increasing regulatory pressures can make their decision-making process slower and less flexible. Alternative finance providers and non-bank lenders. These lenders tend to be unregulated, which means their processes are often faster than traditional banks. However, because many of them obtain funding from sources such as banks, private investment, and crowd-funded, pooled investment, the cost of the finance they offer can be significantly higher. New technologies and platforms have been developed to disrupt the traditional and time-consuming processes of applying for trade finance products, including risk assessment, documentation for importers and exporters, and the provision of credit. Examples of alternative providers include development finance institutions, DFIs, and export credit agencies, ECAs. Development finance institutions are DFIs. Also known as development banks or development finance corporations, DFCs, these institutions typically provide finance as a way to generate or promote economic development. This often applies to medium to long-term projects, such as in the agricultural or mining sectors. DFIs typically operate as joint ventures in emerging markets, where they encourage investment and provide insurance and guarantees against political and socio-economic risks. They can also provide standby letters of credit, SBLCs, invoice discounting facilities, and project finance. Export credit agencies, ECAs. These are government-backed institutions, such as UK Export Finance, UKF, in the UK, or Export Development Canada, EDC, in Canada, that guarantee a domestic company's exports. They tend to structure their finance and insurance around unconventional risks, such as overseas trade liabilities and political risks. Find out more about the different ECAs around the world in our ECA Hub. If you enjoyed our video, please like, comment and share so that this video can reach more people. Thanks for watching and see you next time. And follow us on Instagram at BusinessGreenBR.